If you've watched the first 3 videos in our credit spread series, you probably have a pretty good understanding of how credit spreads work, and at this point might be getting ready to start trading them yourself. Our overview so far covers probably 99% of the trades you'll run into, but there's still a few additional risks you need to be aware of so you can make the most informed decisions possible. For example, there are some situations you could run into where you actually lose more on a trade than what's listed up front as your max loss. Welcome to part 4 of our credit spread series, where we'll discuss additional risks and considerations when trading credit spreads. This is the Hourglass Trader, where as time passes, we make money. So before we get into it, let's take a look at calculating max loss. We'll use AMD as an example here so we can use a real spread to look at as we do this. For this example, it's trading at $92.18, and we'll use the 94.95 call right here where the max gain is 270 and the max loss is 730. Now we know that because it tells us that, but how do we actually manually calculate that so we understand what's going on here? So we've got our 2 strikes, the short leg and the long leg at 94 and 95 right here. And the price of those, let's look back real quick, is going to be $1.38 on the short leg and $1.10 on the long leg. So we know right off the bat that if we subtract these from one another, that's going to give us our max gain on the spread, which is going to be 28 cents. And we got that as our max gain right there. And our max loss, we'll know, is the width of the spread, so 95 minus 94, and then minus that credit, we get that 28 cents. So our max loss is 72 cents. And we know contracts are for 100 shares a piece, so we multiply that by 100. So for every spread we sell, we can make 28 and lose 72. But let's look at actually what happens on assignment here. So this is something really important I get asked about a lot. Upon assignment, you're assigned 100 shares, so your short position for a $94 strike for 100 shares means that you're going to get $9,400 up front. So we'll put that in right there. And for our long position, we're going to pay $9,500, which is a net effect of losing $100. So that's the entire loss on the spread. But you need to remember that we have this credit of $28 that we calculated earlier that we're always going to get. So in the event that our spread is exercised, this is what happens. The whole position, we lose $100, but we get to keep that 28 up front no matter what. So our max loss right here, the actual loss, is $72. So with that in mind, let's start taking a look at 3 of the main risks that we're going to be talking about in this video. They're going to be early assignment, dividend risk, and pin risk. So to kick things off, let's go take a detailed look at early assignment. So for this example, we're going to use AMD again to keep things consistent. It's traded at $92.18. If we look at the chart, it went up during the week, so we're looking at this retrospectively, but we probably, when it hit 90 here, would have looked into opening a call spread, probably somewhere in the 91, 92 area to give ourselves a little bit of a cushion right here. So when we look at the option chain, right here we've got the 91.5, 92 call spread, and it's trading for 23 cents credit. And that isn't a max loss position right now since the stock is above the long leg of 92. But let's throw this back into our spreadsheet and see how it looks. Let's look at the prices for these. It's going to be $2.38 for the short leg right here, and it's going to be $2.15 for the long leg. So like we did earlier, subtract the short from the long, we get 23 cent credit, which is our spread, our max gain, potentially if we sold that spread. But what happens if we get exercised? We know that our spread was in the money, so early assignment is a risk that is in play for us. So let's actually look at what would happen if we were assigned early here. So we're going to put our strikes. Let's just copy this down here to make it a little bit quicker. So right here, when we get exercised, there's going to be 100 shares for each spread that we open. We know that. And we're going to get $91.50 up front from the short leg by shorting the stock. But we can't afford to short that either based on account privileges or the amount of money we have. So we need to exercise the long leg. So when we short a stock, our position is minus 100. Exercising the long leg gets you those 100 shares back, but at a price of $9,200. So again, this is the minus $50 max loss scenario that we have with the spread. And then you've got to remember, we're always going to have that credit that we got up front. So let's say that we sold it for a 10 cent credit. So we'll put that in right here, 10 cents. But we remember that the contracts are for 100, so it would really be a $10 credit. Fix that real quick. So really what happens here is we lose $40 per spread that we sold. And getting exercised when you're in that max loss position is what brings you here. You're getting a max loss due to assignment early. Whereas if we look at our current position, where if we weren't assigned, we would have had our $10 credit, and the spread was $23, which is what we got from up here. We'll fix that. $23 instead of 23 cents. Meaning that if we were just to close our spread, what would happen here is we would be down $13. But since we were assigned early, we actually lose $40. So there's a $27 difference per spread here. So we lose 13 if not exercised and 40 if we were exercised and assigned early. And that's the risk. So looking back here, what could possibly cause you to get assigned early? If we look right here, AMD shares are listed as easy to borrow. That's really important to know, and it means that the risk of early assignment is almost non-existent. If we put something like Tesla in, they're listed as hard to borrow, and that slightly elevates your risk. If shares are harder to borrow, calls are more likely to get exercised, which puts you in a position where you could be hitting max loss early on account of early assignment like we just talked about. And there's some smaller OTC stocks, things like this, that are listed not available to borrow. These pretty much the second that they're in the money are going to be exercised. So that's the risk that you run right there. So let's talk now about dividend risk. When a company announces a dividend, they'll announce an ex-dividend date, meaning that the dividend will be distributed to all shareholders who hold the stock as of that date. So what does that mean for the options you sell? In short, if an ex-dividend date is coming up and you sell a call, you're at risk of having your call exercised because the person you sold the contract to will want to be a shareholder in time for the ex-dividend date so they can collect that dividend. And this can happen even if your option isn't in the money. When someone exercises an option early, they're foregoing all of the extrinsic value left in the option contract. The extrinsic value is simply the difference between the option price and the difference between the strike price and stock price. So if a stock was trading at $101 and a $100 call was trading for $2, that $100 call would have an extrinsic value of $1. If in this example, the company announces a $2 dividend per share, the person who owns this call would likely exercise their call option because the $2 dividend is greater than the $1 of extrinsic value in the call that they own. So what does this mean for us? In short, the safest practice is just not selling stocks when an ex-dividend date is looming. We can check companies with upcoming ex-div dates by looking at the Thinkorswim calendar or by putting the ticker into our watch list. Nothing on our watch list here has an upcoming dividend date, but if we were thinking about selling calls on something like Logitech, we'd throw it into our watch list, and you could see they have an upcoming dividend right here, so we would probably think twice about selling calls on this stock. And just a quick note, this really only applies to when you're selling calls, since selling calls allows the buyer of the contract to take ownership of the stock, as opposed to selling puts, which allows the buyer to assign ownership of the stock to you. So in conclusion with this point, it really is similar to the first risk we talked about with early assignment. It's just another way that you could potentially be assigned early on a stock that you sell calls on. So with that said, we'll get into our third and final point, which is pin risk. So let's say you open a call spread with a short leg of $207.50 and a long leg of $210. We know that if the stock finishes above $210 upon expiration, we'll be in a max loss position, and if the stock finishes below $207.50, we'll be in a max gain position. But what happens if upon expiration, the price of the stock is in between the two legs of your spread? This is where pin risk is introduced. So let's take a look at how this works. All right, so here we're going to take a look at Microsoft, and we're going to open the exact spread that we talked about in our example. It's trading at $208.78 right now. So we're going to do the $207.50 and $210 spread. So we're going to throw that in right here where we sell the 207.5 leg and buy the 210 leg right behind it to make the vertical spread. So if we look at this, the short leg is trading for $3.30 and the long leg is trading for $2.15. If we subtract one from the other, we know that that is a credit of $1.15, meaning that that $1.15 is our max gain on this spread if we were to have it. So let's say nothing happened, and at the end of the week, Microsoft expired right where it is at $208.78. That $207.50 call would be worth $1.28, and the 210 would be worthless. So the spread really would be worth $1.28 at the end of the week if it were to expire, and if we just let it expire. So if we take a look at this, it's worth $1.28 upon expiration, $1.15 when we opened it. We'd lose 13 cents on the spread. So yeah, we would take a loss, but it's a 13-cent loss. Not a huge deal if we closed it out right before expiration. We always, again, to make the point, we always want to close it out before expiration, and now let's show you why. It's because of this pin risk. So let's copy this down here to show you what would happen if we let this expire. And keep in mind, we lose 13 cents on the spread, $13 if we close out before the end of the day. So for the long leg right here, nothing's going to happen since the option's out of the money. We're never going to exercise an option that's out of the money because that's just losing additional money. Now, this short leg that we have is an obligation to the buyer, and they're going to want to exercise it because it's in the money. So that's going to leave us with a short position of 100 shares at $207.50, which is roughly $20,750. Not roughly, it's exactly $20,750 worth of a short position. So let's take a step back and look at what our max loss would have been on this spread. So we take a look at the width of the spread. It's going to be that 210 minus 207.5, going to be $2.50 the width of the spread. And we know that that's going to be net of our credit, which is $1.15. Pull it up right there. And if we subtract one from another, we know that the remainder is going to be our max loss, which, if I can hit the right cell right here, is going to be $1.35, so $135 for the spread. So we know going into it, $135 was the max loss. So let's see what happens if we let it expire in between the two legs and we get exercised on one, but we can't exercise our long leg. So the max loss, again, $135. I probably sound like a broken record at this point. We know that these are exercised by the buyer because it's in the money. So let's say we have the short position over the weekend, and on Monday, Microsoft opens at $210. Remember, we're short at 207.5. So now this short position, since Microsoft goes up to 210, is worth $21,000. And keeping in mind, again, you're short 100 shares here, so we want the stock to go down. And Monday morning, you're going to want to buy 100 shares back to close that position out, likely because maybe you have a smaller account and you can't afford to have that big of a short position. But now your short position is worth $21,000. We wanted to go down. It went up. So it's now $250 greater than what it was on Friday when you let your option get exercised. So really your loss now is $250, whereas before the max loss that you had was $135. Now again, that's going to be net of the $115 that you received up front. But the idea is that this can keep going up. If it goes to 211, it goes to 350. 215, it goes up to $750. And say something crazy happens over the weekend and Microsoft goes all the way up to a crazy number like $230. Throw that in there. Your actual loss is going to be $22.50 net of that $115 credit. So on a play where you thought you could have lost $135, you're now out over $2,000. And if you're making a play like this, where your max gain is $115 and your max loss is $135, you might be doing that because you have a smaller account where you're trading $400, $500, $600. You can't afford to have a $2,000 loss. So the big thing we want to take away from this is to close your spreads out if they're remotely close before expiration, so you could take that $13 loss as opposed to having a short position over the weekend, having some news break, and having something like this happen to you where you lose way more than you can afford to lose. So that's going to do it for all three of the risks that we wanted to talk about in this video, which brings us to the end and to the end of our credit spread series. Now, this was part 4. We may make a part 5 if we get some more questions and other things that we want to address. But for now, this is going to be the end of the credit spread series. So if you made it this far, I really appreciate you taking the time to watch all these videos. If you have any questions, feel free to reach out to us. We've got all of our social media accounts listed right here. Give us a follow on Twitter. We've got a Discord server now. The link to that is going to be in the description of this video. And as always, like, comment, and subscribe if you haven't already. We try our best to answer all the questions you guys might have in the comments as quickly as possible. But that's all we got in the meantime. We're going to get into some different option selling strategies, some puts, some covered calls, some like the wheel, the triple income strategy. And I think you guys are really going to like that if you got all the way through this credit spread series. So thanks for watching, and hopefully the more you learn, the more we can get you in a position where as time passes, you make money.